Good afternoon, everyone, and thank you so much for joining us today. This is Donna McLaughlin here at Underwriters Marketing Service, and I lead the annuity department here at UMS. I want to thank everybody for joining us today. Before we get started, I do need to go through just a few logistics. There are a number of people on this call today, so I do have everybody muted. If you have any questions throughout the presentation or at the end of the presentation, Jonathan will do a Q&A session at the end. If you could just please type those into the questions bar or the chat bar to the right-hand side of your screen. Also, this webinar is for financial professionals only, and it will be recorded. If for any reason you are not a financial professional or do not wish to be on a recorded line, please do hang up now. Okay, let's get started. At Underwriters Marketing Service, as many of you know, we are your back office support for your fixed indexed annuity, life, long-term care, disability, and Med Supp business. Today, we would like to focus a little bit on the annuity side and even more so on 401ks and pension plans and how we can help you, our advisors, and our agents, if you are working with small businesses and small groups, how we can help you present this to your clients and give them the easy process of doing this. I have Jonathan Sachs here today, partnered with us for many, many years with American National. Jonathan Sachs is a pension design consultant over at American National, and he has over 15 years experience in both the pension and financial services industry. He's worked both as a licensed agent and as a securities representative, so he knows what it's like to be out in the field with clients. Jonathan, please take it away. Thank you so much.
Thanks, Donna. Thank you very much for having me, and thank you to UMS. As Donna said, we've had a wonderful relationship with UMS, and I thank them very much for allowing me to be back today. We're going to talk about retirement plans, and as Donna said, there will be a Q&A at the end. So if you have any questions, please write them down. Don't forget them, and we can get to them at the end. We'll answer all questions, and then, of course, I'm always available when it comes to questions about prospects or even different plan design. With that being said, so what we're going to talk about are different types of plans. Also, what we're going to do is talk about marketing, where they fit, how they work. And then we're also going to challenge you. There's going to be a challenge inside this presentation, and we'll get to that in just a little bit. But American National is based out of Galveston, Texas. We've been around for over 100 years. And my name is Jonathan Sachs. I am one of the plan designers, but also I enjoy doing these meetings very much. One of the things about retirement plans is around tax time, they become very, very popular. And this year is no different. Okay, fine. Last year was very different, but it's still tax time. We still owe our taxes. We still have to keep the government afloat. And when it comes to this time, we're always looking for ways to either benefit our retirement, save on taxes, plan the next year, and let's face it, it's really a combination of all of the above. So aside from it being tax time, why is now a good time for you to be talking about retirement plans? And there was something called the Secure Act that was passed just recently. It had some really interesting pieces to it. The pieces, of course, that I'm concentrating on are the pieces that are important to qualified plans, to what I do, to what I'm going to entice you to do. And the Secure Act did some house cleaning things like raising the contribution limits. They're typically raised every other year. But some of the neater things they did is they raised the required minimum distribution age from 70 and a half to 72, which is very helpful. And then one of the things that we really need to zero in on is that they have changed the deadline to set up a plan. See, it used to be that you couldn't get a hold of me in December. Getting a hold of me in December is like trying to call your CPA on April 15th. It just doesn't happen because everyone's trying to get their plan closed and their plan inside and set up and ready to go by 12/31. because the end of the year was a deadline for a lot of these plans. So again, my Decembers were just crazy. Well, now you can set up qualified plans retroactively, just like you can do with an IRA. So it eased my December some. It's now making my Januaries crazy, because here I am in January. Normally my Januaries are not busy at all, but I've got multiple plans on my desk that are 2020 plans. These clients are going to put 2020 plans together. They're going to make a prior year contribution. They're going to get a tax deduction for that prior year, and it's breaking new ground. It's just absolutely uncharted territory. But it is an excellent opportunity for you to go and talk to your client base, because I'm in the industry, and the only reason I know this is because I get to read these things when they come out. And I know clients don't read things, let alone their statements every month, right? So here's an opportunity for you to go and talk to your clients. Hey, did you know that you can still do this for 2020? Well, the deadline passed. Well, no, the deadline changed, because the laws are constantly changing. And that's what we do. We stay on top of things. So we're going to talk about setting up plans in 2020, or for 2020 in 2021. And then, of course, we're going to talk about plans for 2021 and beyond. So that's really, really interesting stuff for you and me. But what else about the qualified plan? Well, the qualified plan is still a qualified plan. You still get those tax deductions, the ability to save for retirement, employee retention. All of these things are still true with these qualified plans. At American National, we specialize in the small business market, which is a very underserviced market. We're going to touch on that. But these plans still do what they've always done. They're just a little bit better now. At American National, we do 401k, defined benefit. We will take over an existing plan. And when it comes to defined benefit, we do cash balance and 412. We add life insurance or not. On the defined contribution side, all of our 401ks are Roth 401ks. We can do new comparability. So we really do pretty much everything in the qualified plan arena. The exceptions are your 457 plan and your 403b. We just don't do those. And what I mentioned prior is that these laws are constantly changing. And this is another example. That's actually the reason this slide is here. Because we would have agents that go out and talk to sole proprietors and partnerships and explain to them this is the greatest thing since sliced bread. And then they come back and say, oh, no, my CPA said I can't do this. Well, see, that's an old law. It used to be that your sole proprietors of the world, your LLCs of the world, your partnerships of the world, it was really, really hard, if not impossible, for them to set up these types of qualified plans. Those rules no longer apply. As a matter of fact, we now even set up plans for nonprofits all the time. Now, setting up a plan for a nonprofit, of course, the enticement of that tax deduction is no longer there. But if you're trying to retain employees or attract new employees, or if you're just trying to keep the board together and happy, you might want to offer them some type of retirement plan. And that's exactly why the nonprofit set up that type of plan. So I mentioned we specialize in small businesses. Our target market is 25 or less. We will go all the way to 100. And we even do have a couple plans that exceed 100. A plan that exceeds 100 lives, we will have a conversation with you and the client explaining our limitations. And if those limitations are acceptable, then you're welcome to set up the plan. Matter of fact, I just set up a plan last year for 180 individuals because this guy was running an Amazon delivery truck service, and he literally went from 10 employees to 100 employees in, I think, 3 weeks. Very successful business and a very great story. But the point is, it doesn't matter what comes across your desk, bring it to us. I'll always run it up the flagpole because we're here to do business. So this is what differentiates us from our competitors. Our competitors typically won't touch one-person plans, small plans with less than 10 or 20 people in them. And so the amount of competitors we have can almost be counted on one hand. This is one of the advantages that we have here at American National. One of the other advantages we have at American National is plan design. Our plan designs are customized to each individual that comes across our desk. You bring us one prospect, you bring us a second prospect. Those two plans probably will not look the same because we design them specifically for your client. And that's very important. Let me show you why. So you're going to run into clients that have already started doing something for retirement, whether they're doing it to accumulate their own wealth, whether they're doing it for the tax deduction, for the employee retention, regardless. They've already started doing something in the retirement market. And normally, it's their CPA that puts them in a SEP IRA. And the SEP IRA is not bad. I mean, it's there for a reason. But it's not the best either. In my first example, I'm showing an individual who's age 50, making $50,000 a year. The reason I'm choosing age 50 is because once you attain age 50, you're allowed a catch-up provision inside the 401k plan that is $6,500, which is not available in the SEP. So right off the bat, if their individual is age 50 or older, I can automatically put more money into the 401k than I can a SEP. But the other thing is the 401k has a profit-sharing contribution, also known as the employee contribution, employer contribution, and it is the same as a SEP, meaning it is 25%. A SEP is limited to 25% of income. So if you look at the first example, 25% of 50K, that's where you get that 12.5. In the 401k, we can match the 12.5. And as I said, you have the catch-up of $6,500. But then the employee can contribute up to 100% of their income, not to exceed $19,500. If you add all of those three buckets together, the 401k beats the SEP by more than double. So do we show them a better plan design? Yes. Does it beat their current plan design? Handedly, right? If we take the same individual and we double their income, doesn't matter. I still beat them. Now, I'm not beating them by as much, but again, I'm still doubling it. This is how important plan design is. The other thing I'm trying to say here is when you go and you talk to your clients and you run into a client that already has a life policy or an annuity, you just kind of, okay, thanks, bye, and look for the next one? No. You offer a free review. When was this last time the plan was reviewed? Maybe when you set up your plan, you only had 1 or 2 employees. Now you have 10 or 12. Your needs have changed. Your goals have changed. Shouldn't the plan change with you? Just because they have an existing plan, don't walk away. So one of the things I also mentioned earlier was the Roth 401k. I call the Roth 401k the great equalizer. And the reason being is the Roth IRA has 2 major issues with it. The first problem with your Roth IRA is the contribution limit is only $6,000. If they're age 50 or older, there's an additional catch-up of $1,000. It's not the worst thing in the world. It's not the best thing in the world. But the other thing about the Roth IRA is the government said, look, if your client has the audacity to make too much money, they can't be in it anyway. This phase out I'm showing is for married filing jointly. So if you're married filing jointly and your income exceeds 208, you don't even have the ability to make a Roth contribution. So along came the Roth 401k. The thing about the Roth 401k is the Roth 401k is governed by ERISA, meaning it's a federal plan. Being a federal plan, they cannot discriminate. Therefore, the age and income requirements are gone. I don't care if your client's making $1 million a year. They now have access to Roth. Roth is now available to everybody. But not only that, the contribution limits in a Roth 401k are that of a 401k, not the IRA. So instead of putting in $6,000, you can do $19,500. Instead of a $1,000 catch-up, it's a $6,500 catch-up. And here it is extrapolated. So you could actually have both buckets, a tax-free bucket or a Roth bucket, and a taxable bucket or a traditional contribution bucket. As long as the distributions are qualified, meaning at least 5 years old, the account, client is over 59 and a half, the money comes out tax-free. We're talking about qualified tax-free retirement money. Where else can you find that? Where else can somebody go to get tax-free retirement income? The only place that I'm aware of is life insurance, and it typically has something to do with overfunding a policy. It's not a bad idea. Biggest problem with that plan, client has to be insurable. And then the other issue with that plan is the cost of insurance that's eating away at the actual money. But I'm not here to pit this against your insurance. Because when we all started in this industry, we were taught one thing: diversification. Don't put all your eggs in one basket. Do both. Your clients got their life insurance policy set up. Oh yeah, this is my retirement policy. Great. Do both. If you have a client who's overfunding a life policy, what do I know about your client? I know your client has more money sitting on the sidelines. If you're overfunding a life policy, you've got money. Do both. Make another sale. The other side of the fence, what we just talked about are 401k plans, also known as defined contribution plans. This is a defined benefit plan. So if the client is looking for something, trying to hit a home run, something that's really, really meaty, we start looking at defined benefit plans. If you look at this illustration, your owner is typically older than the employees. What you can't see here is the owner typically makes more money than their employees. So in this scenario, we're doing a defined benefit plan. The owner is keeping over 85% of all of the assets in the plan. The remainder that's going to the employees is easily covered by the tax deduction. What tax deduction? Well, your annual contribution into the plan, remember? We're looking at an annual contribution of roughly $116,000. That's a tax deduction. Could you imagine if you walk into your small business owner's office and you say, hey, I think I can find you a $100,000 tax deduction. Do you think they're interested? I was once on a call with a client and the CPA and the agent. We were going over the illustration. And the client turned around to the CPA on the call. He's like, why have you never shown me this? You know, aren't you supposed to be my tax deduction guy? Isn't that your job? Well, yes, their job is to file taxes and do your taxes and that kind of stuff. But it's not to know qualified plans. That's why I'm going to talk about you partnering with CPAs to talk about this kind of stuff. It's that important. So your defined benefit plans started going away. And they were in the headlines, especially 20 years ago. They were in the headlines every time you turn on the news because everyone was getting rid of their defined benefit plans. They're making a huge resurgence, again, because of law changes. Tax law changed. It used to be that when you made a defined benefit plan and you made the contribution, that contribution was written in stone, and every year you made the contribution no matter what. And you're on the hook for the performance also. So if you don't meet the required performance, you got to make that up too. So what the law did for traditional defined benefit plans is it made that contribution flexible. So at the end of the year, our actuaries crunch the numbers and they send a letter out to your client. Dear Mrs. Client, congratulations. It is now time to fund your plan for the first year. Your minimum contribution is $54.50. Your maximum deduction allowed this year is roughly $146. Remember from the previous slide, the target was only $116. We explain this to the client. We vet the client. Client has a really good year, and they fund at the maximum in the first year, which is what we want them to do. We're coming darn close to it. Because by funding the maximum, when year 2 rolls around and that letter goes out to the client, that padding, that extra that you funded over that 116, look what it did to the minimum contribution requirement. The client had another really good year, and instead of funding at the maximum, she just went for level funding and put in the same amount she did last year. We explained to our clients that in the first couple of years, we want you to max fund this thing. Why? It's not because I want you to have a maximum tax deduction. I mean, yes, that's beautiful and it helps the sale. But it's because I want you to build up the flexibility of the plan so that in year 4, 5, 6, somewhere down the road, if the company runs into a roadblock or a big old pothole and needs to take a breather, they can. We never recommend that a client misses a year of funding because basically what happens is this excess that you're putting in is just a surplus account that's being held almost like an escrow account. And if you were to deplete that account by putting in 0 one of those years, well, then the following year, your minimum would shoot back up to $60,000 or $70,000, depending on how far along down the line you are. You don't want to do that. So what we do is we typically have everyone coming in and encouraging them to put something, $20,000, $30,000, $15,000, put something in there. Do not go to 0. But again, this is part of plan design. We vet the client, we make sure they understand. And because of this flexibility, traditional defined benefit plans and your cash balance plans have made a massive resurgence. The amount of defined benefit plans we do now is easily double what we used to do, if not even more. So defined benefit plans are very, very enticing, and they're very, very powerful. But, you know, you show it to your client, and your client's like, you know, this is great, but I'm a little risk adverse. I don't like that investment being an albatross for me. Or maybe they say, you know, this looks great, but can we do more? I love it when they ask if we can do more. And so that's where the 412 comes in. Now, why did I say they're risk adverse? Well, because the 412 plan is also known as a fully insured defined benefit plan. Okay, what is that? All that means is that the investment vehicles that we're using are fully guaranteed, meaning we're using a fixed annuity, not a fixed indexed annuity, a fixed annuity. Excuse me, I'm taking a sip of water. The other thing is, if we use life insurance, it's whole life insurance. Both of these products are fully guaranteed. So what does that mean? Well, that means that you don't have to worry about geopolitical issues. You don't have to worry about what that crystal ball is going to say happens 10 years down the road from today. You can sleep at night knowing that you've got your golden goose fully guaranteed. What we recommend typically is you open a 401k alongside it and you go and do the crazy stuff in the 401k. You want to invest in aggressive growth? Go for it. You want the S&P 500? It's right there. You want biotech? You want technology? Knock yourself out. But you know that this part is guaranteed. Now, you know, one of the things about guarantees is if I'm guaranteeing my side, you have to guarantee your side, right? So one of the things about the 412 plan is that annual contribution is required, mandatory, written in stone, no ifs, ands, or buts about it. That's why we don't sell a lot of 412 plans. Take a look at this illustration. It's a $200,000 annual contribution. Assuming a 50% tax bracket, here's a $100,000 credit to your taxes. Could you imagine showing a small business owner a $100,000 credit? I mean, short of depreciating a building, maybe a fleet of sales vehicles, you don't see these types of deductions. But the thing is, if you're going to run this, he's 52. You can see the owner's 52. If you run it to age 62, that's 10 years. That client just committed to $2 million, right? $200,000 a year for 10 years. Raise a hand. In today's world, who wants to commit to $2 million over the next 10 years, right? That's a pretty hefty crystal ball you got there. You better have a really, really, really successful company and or the money on the sidelines. So these plans are few and far between, but man, when they work, do they work. You can see this one, I've used life insurance. So the total premium between the two is what the total contribution is. So look at this. You're looking at $144,000 of annuity and $53,000 of life. It's not bad. Now, what a lot of people say is, okay, well, so basically, if I didn't put the life insurance in there, I'd get to save $53,000, right? No. The life premium is not just added to the plan, and that's what this slide is showing. The blue side is when you're using life insurance. I know it says split funded. Actually, I probably need to take that off because in different nuances, split funded means something completely different. But in this case, what we're talking about is being funded with both annuity and life insurance. On the other side, on the green side, you see if they took the exact same plan, exact same benefit, but annuity only. Now I'm going to come back to this slide in a minute. But here it is. So if you added the life insurance, you're not talking about a big difference in price, right? So let's talk about this for a minute. There's a couple of things I want to say here. First of all, putting life insurance inside of a 412 plan is an afterthought. Why? Well, think about it. If you've sold somebody on the concept of a 412 plan and they're ready to sign on the dotted line, you can do that. Oh, wait, I've got one more thing. Oh, yeah, what's that? Well, what if we insured this? Well, I thought you said it was insured. No. What if we could give your loved ones the same retirement money, even if you're not there? We can add $2 million of death benefit coverage. Oh, no. There's no way I'm paying for that. I know that's going to cost tens of thousands of dollars. No. Not in this plan, it's not. I'll add $2 million of life insurance for an extra $5,000 a year. That's nothing. For an extra 2.5%, because remember this was a $200,000 annual contribution. For an extra 2.5%, you'll get $2 million of life coverage. The plan will self-fulfill itself if something happens. The better way to say this, did you know that life insurance is on sale right now? Life insurance is on sale in 412 plans. Why? Well, you're buying life insurance inside of a qualified plan. Yep, I know that. You get a tax deduction for any contribution into a qualified plan. Yep, I know that. Wait a minute. So you're telling me I can buy life insurance with pre-tax dollars? Yeah, I am. So if your client is in California or one of those crazy states that has tax on top of a tax on top of a tax, and you're looking at 50 or 60% tax, life insurance is on sale. I mean, even if you're in a 30% tax bracket, still life insurance is on sale inside a 412 plan. Now, in order for life insurance to maintain its tax-favored death benefit status, the client is 1099'd at the end of the year for the equivalent of 1 year of term insurance. So a couple of grand, depending on how old they are, how much life insurance they're getting, etc. If you're selling 412 plans, there's no reason not to put life insurance inside of them. Because if you take a look at this, would you rather get the commission on a $180,000 annuity or a $137,000 annuity plus a $50,000 life premium? I know y'all can't see me, but both my hands are up. I'll take the $50,000 life premium, please. By the way, you just went on the next UMS trip too. So this is great. I really like what I see, but who do I talk to? And the answer is everybody. Again, doesn't matter if they're a nonprofit. Talk to anyone, sole proprietors, partnerships, everybody. Everybody, including your current book of business. You're always trying to find a way to stay in your client's mind so that if your client needs something down the road, they're going to know, you know what? Jonathan knows this. Let me call Jonathan. Well, that's because I stay in contact with my clients by offering them and showing them new things. This is your opportunity to go back through your book of business. You know, Mrs. Client, we've done business in the past, and thank you very much. But we've still not talked about your retirement plan. Oh, I didn't know you did retirement plans. Let me ask you, whose fault is that? Whose fault is it that your client doesn't know you can help them? You should be talking to everybody. If you know a CPA, great. Tell them you're going to do a client appreciation dinner. I want, maybe for the first time, only 5 people. I want 5 people, small business owners. They either have a retirement need, a tax need, or both. Bring me 5. Your CPA's in the room. His clients are in the room. You now have a room full of pre-qualified warm leads. Talk to them about this. Now, remember I told you I was going to challenge you. Here it is. At American National, we have an advisor program. What that means is if you set up your own plan with us, there's incentive. If you set up your own plan with us, we will waive the setup fee, which is typically $600, and you will have a plan. If you have 3 plans with us, so bring us 2 plans, and your plan is the 3rd. If you have 3 plans with us, we waive your annual administration fees. Now, compliance is not in the room, so I can tell you that means you have a free plan. No admin costs at all. Why do we do this? Well, because if you have one of these plans for yourself, the chances of you selling it to somebody else goes up. Do you remember the first time you tried to do a life policy? Or even fill out that app? You know, eventually you wrote a policy on yourself and everyone else in your family, but you wrote a policy on yourself so that when you went and spoke to your next client, you spoke with more conviction. Mrs. Client, this is what I've done for myself. That's how much I believe in this product. The same thing applies here. I mean, what, you don't want the tax deduction? Or maybe you don't need to save any money for retirement? Or maybe you just don't want the commission? Why would you not set up one of these plans for yourself? And that's what we're here to do. We're here to make it real simple for you. We're going to give you a proposed request and census. You get them to complete it. You send it to us. We'll do the rest. What does it look like? Well, the proposed request and census form, which we'll actually go over here in a moment, is available in PDF, so we can email it to you. I would always keep a copy and carry it around with you. The first thing we need is to know about the client. Then if the client kind of has an idea of what they want, they have an opportunity to let us know. Ultimately, at the bottom, there's a box down at the very bottom that says, check here if you're unsure and we'll do the rest. That's really all you need to do. If it's a takeover plan, we will need additional information and we will walk you through how to get it. Lastly, we need a census. We need to know what we're dealing with because we need to put a proposal together. Like you saw the previous slide. I have to know information in order to show you what it looks like, what it spends, what the advantages are, and how it works. Once you have this census, I need it, but keep a copy for for yourself. Why? Because this is your opportunity to go and do some cross-selling. You now have every single person's name. You know how old they are. You know how much money they make. Go and talk to them. Go make another sale. Once we have the proposal request and census form, we'll create a proposal, send it to you. We'll discuss it, explain it. If you want me to present it to the client, great. We'll set up a conference call. If you want to explain it to your client, I'll make sure you're ready. But I'm here to walk you through it and or do it for you from the very beginning to the very end. We've partnered with Morningstar to help the 401k participants with their investment decisions, because one of the neat things about our plan is you don't have to be securities licensed. Now, because of where UMS is located, I'm going to tell you that the state of New York, this is not available, period, end of story, full stop. So New York's out of the question. The states of Connecticut and Massachusetts, the plans are available, but Connecticut and Massachusetts says, I don't care what the law says. If you're going to sell this product, you have to be securities licensed. So you will have to be securities licensed in Connecticut or Massachusetts if you want to set up a 401k plan. We have wonderful resources available to you. This is our starter kit. There's pre-approach letters in here. There's phone scripts. Everything you need to get you off and going. Our website has everything that you need on it. And Bob Klein is my boss. There's 4 of us here. Between the 4 of us, we have over 100 years experience in the market. So if you've got a question, bring it to us. Use us as your back office. Whether it's technical in nature or not, it doesn't matter. Call us, ask us. If I don't know the answer, I'll go to one of my colleagues. If not, we'll dig and we'll find it and we'll get back to you. So I do apologize. I did go a little bit quickly. But Donna, if there are any questions, I'll be happy to answer them.
Thanks, Jonathan. Thank you for such a great presentation. And if anybody has any questions, you are on mute right now. I do have a few questions that have come in, but just to remind everybody, the questions bar should be on the right-hand side of your screen. So Jonathan did reiterate towards the end that you do not need a securities license except in the states of Connecticut and Massachusetts in order to do these products. But one of the things is, Jonathan, when you're looking at this as an insurance agent, 412Es, 401ks, pension plans, defined benefits, how does one know which plan to pick or go to? Can you tell, kind of walk through what American National does to help us?
Yeah, absolutely. Thanks, Donna. That's a great question. I love that one. So I've been doing this a long time, and there are a lot of options out there. And sometimes there is more than one option that meets the client's needs, and we'll show that to you. But ultimately, I don't want you to be bogged down with knowing what type of plans work for which client. Let us take that burden from you. Get the proposal request and census and explain to your client, Mrs. Client, I've got a back office full of these really bright people that sit in rooms with no windows, and they will find the plan that works best for you. I will come back with an illustration, and we will explain everything to you. And that's really the best approach is, look, let us get something in front of you. Let us get this proposal request and census done. And, in that process of creating the illustration, we also determine the plan that works the best. If we have to pivot at the end, we're happy to. I mean, ultimately, it's the client's, choice. But if you want to learn more about the different plan designs, I'm happy to make you fall asleep with all of that boring information. But ultimately, you don't need that information. Get us proposal request and census, send it into us, and we'll take care of it.
Thanks, Jonathan. And just, I do have a few more that are coming through. But again, I want to reiterate, because Jonathan, you helped me do my own plan. And as Jonathan did propose to do this on your own and to help empower you to do this with your clients. But, Jonathan, you walked me through everything. You put the plan together. You told me what to do. And I know you get on the line with the agents, their clients, their CPAs, anybody that they want to put on that call. You'll get on the phone with them and really walk them through it, and as well as your staff, correct?
Absolutely.
Okay.
I'm not bashful. I don't know if you can't tell.
What product do you use? What product do you use when you're replacing an existing 401k or a defined benefit plan?
Right. Great question. All right. So one of the things we do at American National is we do not want our agents to be fiduciaries of these plans, because then it becomes a very slippery slope. We offer a platform. That platform is a group variable annuity. So yes, it's a variable annuity, but no, you do not have to be securities licensed. Your exceptions are Connecticut, Massachusetts, and New York, of course. This annuity has 52 investment choices. Has target date funds, allocation-based funds. It has S&P 500, global real estate, biotech, technology. It literally has a little bit of everything for everybody. And that's important because it has to be able to meet everybody's needs, whether they're conservative or aggressive or in between. That's where Morningstar comes in. If you're not securities licensed and one of those participants comes and asks you for investment advice, you shouldn't really answer that question. Now, I'm not in that room with you, but that's what Morningstar is for. Every participant has the ability to have Morningstar give them one free asset allocation. Then, if they want Morningstar to actually actively manage that account on a day-to-day basis, Morningstar will do that as well for a fee. And that fee is 0.5% or 50 basis points per year. If you've ever looked at assets under management, 50 basis points a year is a deal. So our main investment platform is our WealthQuest 3 group variable annuity with 52 investment choices. Sorry for the long answer.
No problem, no problem. And how would you differentiate yourself with a traditional 401k salesperson and this product on the initial call? So how do you differentiate, I guess, American National?
How do I differentiate us from the competition? Well, let's just end it with saying me. No, I'm only playing. So how do we differentiate from our competitors? The first thing that we do with our plans is we're not going to tell you, look, since you only have 10 people in the plan, you can only have 10 investment options or 12 investment options. So everyone gets the entire suite to use regardless of the type or size of their plan. The other thing is we're one-stop shop, hence the name of this presentation. What I mean by that is everything is done in-house. We design the plan, we implement the plan, it's our investment product in the plan, we administer the plan, we do the 5,500 filings. So everything that is necessary to run the plan, administer the plan, take the plan from day one to the last day, everything is done in-house. You don't have to go and find a third-party administrator. You don't have to go and find an investment vehicle. You don't have to go and find anybody. It is a turnkey solution.
Thank you. Yeah,
and,
good. Go ahead.
And lastly, I'll say a lot of our competitors, they're kind of like a grocery store. You just go and you pick up what's on the shelf, take it or leave it. Where here we do a customized approach to every plan design. And that's why we end up taking a lot of plans from your cookie cutters of the world, like your ADPs and your paychecks. They specialize in payroll. They don't specialize in retirement.
Thanks, Jonathan. Thank you. And in order to get this started, you will need to fill out a design questionnaire, and that is something that I will send to everybody that's on today's call. And again, I empower you all to look at your own plan, look at your, whether it's just you as an entrepreneur, if you have any employees under you, to get this started. And Jonathan, you're wonderful. You send that questionnaire into me. Jonathan or somebody on his team, they basically will run the proposal. They will explain everything to you. They'll get your client on the phone, and they will just do everything for you from that point on. All you need to bring is a relationship to the table. So again, Jonathan, I think that's it for the calls. I don't see any more that are coming in. Thank you so much for bringing this great opportunity to us. And thank you everyone for joining us. You will get another email from someone on my team about with the pension questionnaire information and how to move forward with working with American National. So thank you again for joining us today. Thanks, Jonathan.
Thanks, Donna. Thanks, Underwriters Marketing.
Have a good one.